Loud. Well, good evening, everybody, and welcome again, guys. I hope you've all had a fantastic week. It has been certainly quite an interesting week, I would say, with some antics in the US, which I'm sure some of you have from the posts on Facebook, getting involved in GameStop and the rest. It's certainly been an interesting one. I'm sure we can have a little discussion about that at the end. But as per the post I put out there, I've asked Paul. We've got his slide up here this evening. I was going to do an intro without the slides, but we'll put the slide up here to save any IT faff. Paul McElroy is going to do a little chat about SaaS. Now, I've asked Paul to do this. Now, I know a lot of you have kind of come from property backgrounds and things like that, and obviously you've seen SaaS used in the property space, or you've read the books and you've seen how it can be used in the commercial aspect. But obviously, as per what we do in this group, I wanted somebody who's a specialist in other avenues, what else it could be used for, and not just property, all those different assets class. Somebody who is like myself, say, leaving the military or leaving a public sector, NHS, police job, where you can't transfer your pension. I went for years thinking, actually, this doesn't apply to me because I can't touch my pension. Yet very recently, in fact, on talking with Paul, I realized that I was missing a massive opportunity for tax-free or tax-efficient benefits, which I'm sure Paul will talk to you about tonight. And that's why I've asked Paul to come on tonight rather than one of the kind of property specialists. Paul himself, I know he's going to do an introduction, but he was the director of one of the largest IFA companies in the UK with specialist knowledge across business, individual exits, financial goal settings, shareholder issues, and many, many other things, which I'll leave him to talk about now. So I'm going to hand the mic over to Paul. There'll be 101 questions. There were when I announced that we were going to do this session tonight in the group. So there's, I've already seen a number of the questions that you've got. If you've got questions, guys, please drop them in the chat box and I will manage them for the end. If it goes over or there's more advanced questions, Paul's very kindly said that he will come back to do the more advanced or specific questions to your potential needs. But without further ado, Paul, please take it away.
Thank you, Richard. Yes, hello everybody. I'm not used to presenting. It's been a long time since I have on Zoom or anything, so bear with me. Hence why we've got the slides already up. Yes, firstly, then this is about SaaS pensions. They have been around since 1973, and when I've been seeing SMEs, business owners, the first thing they ask when they realise what these things can do is, well, why haven't I heard of these before? And then they say, well, I'll speak to my accountant and check with him or her. And the accountants have never heard of them before. And so they are they're not very widely known. I think in the property world, they're becoming more widely known. And it seems that everyone and their dog who knows a little bit about SaaSes wants to mentor people on them, having had very little or no experience. So yes, specialist in the SaaS arena. And have been working with SMEs since about 1995, qualified as an IFA, and as Richard said, built a ex-Royal Navy way back, electronic engineer, you'll see that, but yeah, and I enjoy what I do. So moving on, let's bear with me a second. It's not going down.
Just click on the...
It's frozen, I think.
Here we are. We tested it to the end.
Yeah.
Have you just got a PowerPoint right button instead of?
Yeah, let's just try that. Let's try that.
Oh, you're right. Here we are.
So forgive me. Yeah, I was an electronic engineer back in the day. So worked in research and development after leaving the Navy. And I've worked in financial services for 28 years plus, with SaaSes and dealing with all sorts of people in all sorts of industries with that organisation. And we actually had our own SaaS company with a few hundred SaaSes in it. But that business was eventually sold, and that SaaS company sits with the acquiring company, and they don't really know what to do with it because it's not really their bag of tricks. So interestingly, they're not really used much. So I've worked in financial services for a long time. I'm recognised for a proactive approach to each individual and their business circumstances regarding the tools available for sensible planning for each business. And a quick note here is that really circa 98% of IFA
Paul, we've
lost me.
Yeah, you lost your sound.
Yeah.
Okay.
Okay.
You're back now.
Okay. Sorry about this. This is why my son was here. He's a computer scientist helping me out before we started. Can you hear me now? Okay. Yeah.
Yeah. All good. All good.
Yeah. Yeah. 98% of IFAs do not understand or know the benefits of SSAS. So if you ask one, there's a good chance they'll poo-poo it or say do a SIP or say it's not really for you. But some of the good ones will put you in, we'll talk to you about them, do their studying, and then put you in touch with a good SaaS provider. Next, basically the key benefits with the SaaS is that you're in control and not the provider. And that's something we'll touch on. Legacy is that you can hand it down to your family through the generations, and through your wife, husband, children, whatever. So assets can be held all the way through, down to your children, etc. And there are major tax savings and greater returns generally. Now, there are infinite options with SaaS with many USPs, unique selling points, and we'll touch through some of them, but that will only cover some, not all. So it's important to know that, yes, they're good for property purchase and all the rest of it and loan backs, but they're also used for business, for growth and to grow the business, etc. So, to grow the business and also help with an exit. Yes, so you're in control, not the pension provider. So it differs from a SIP that way. And just touching on the SIP, what does a SIP do? Well, a SIP has a trustee, which is normally the provider. So if you take, I don't know, Aviva or someone like that, they are the trustee, and they decide which valuer you're going to use. They decide, because they're the owner of the assets. They're the trustee. They decide which valuer you're going to use, which solicitor you're going to use, if it's on their panel or not. So if they don't agree with what you're trying to do, they won't allow you to do it. So that's the first thing with a SIP that you don't have the issue with in a SaaS, because they're in control, not you. The other thing with a SIP is you can't do a loan back. So you can't loan money back to your own business. And although SIPs are plentiful and they are self-invested personal pensions for individuals, and you can set one up as an individual, pretty much anyone can set one up, you don't have as much control or choice and as you would with the SaaS. So that's the key differences between the two. It's actually very simple, the difference between SaaS and SIP. There's not much to it. And then the thing I was going to mention then was the legacy. It's a legacy product to SaaS. So the one key advantage with this is, I've had experience where somebody had a defined benefit scheme. I'm not knocking them, they're brilliant in many cases. But what happened was the wife only inherited 50% of 40 years worth of work when they could see when they died. And if the wife is not around when they die and the children are not dependent anymore, the fund goes with them. So after 40 years hard work, the fund is completely gone. And actually, I know of somebody in my industry who worked with somebody. He passed away. His wife only received 50% income, and then when she died, the whole lot was gone, and that fund was worth £1 million. So a bit of a concern. There are obviously certain types of pensions you can't really move out, and you shouldn't move out, but that's just worth knowing that. So the difference with a SaaS, it's a legacy product, which basically means that you can, once you've brought the asset in from other pensions or paid the money in, you can make your wife, husband, children, trustees, and members. And when you're not here anymore, they can receive the benefit of that of those assets free of tax within the same scheme, because a SaaS is inherent tax free. Next thing is tax efficient growth. Well, within the SaaS, you've basically got tax exempt growth, provided that you are invested in tax exempt and approved investments. The usual things like, you know, stocks and shares and investment funds and other things. So the growth within the scheme is actually free of inheritance tax. So it's one area that's free of inheritance tax. Another one is shares you would hold in a limited trading company that you've held for more than 2 years that's trading, and you've owned more than 5%. So if you hand that down to your family, there won't be any inheritance tax normally in that, and you will qualify for business property relief. So that's a second benefit. And of course, you've got your personal exemptions for personally owned property, which currently is about it's £500,000 each. So if you plan correctly with your personal assets like your house, etc., with your business and with your pension, you can actually mitigate an awful lot of inheritance tax when that goes down to your family. And of course, in mitigation of tax, you can also use things like reinvestment into trading businesses through other investments elsewhere. It's worth knowing that. So tax efficient growth, which is free of inheritance tax, free of capital gains tax, because the gains grow, compound growth is tax free. There's no income tax unless you draw the benefits out of it and you take your tax-free cash. Once you take your tax-free cash and you draw income out of it, it's taxable to income tax, but that's on the exit, not on the internal mechanism of it. And there's no corporation tax either. So provided that the investments are allowed. You've also got, as I said, compound gross via gross roll-up, and property owned is protected from creditors. People forget this, that if you've got property owned in a SSAS, nobody can touch it. I remember a few years ago, a chap who I thought was running quite a good business, but it just went pear-shaped. He had a creditors meeting and he called me up and he said, can you confirm to me that they can't take the asset off me, the property that's in the pension scheme that he worked from? I said, they can't. They can do whatever they like. They can't take it because it's protected from creditors. It's your pension at the end of the day. So, so that's that. Next one. What is a SSAS? Well, basically, it stands for a small self-administered scheme. It's a pension scheme. It has the facility to have 11 members in it. The maximum number is 11, but generally a lot have one. You're better off having two, because when you die, you've got to tell the trustees who you want to benefit from that. And if you're not around anymore, then there isn't a trustee. So it's always best to have a corporate trustee who effectively works as the compliance person or organisation in the background, or a scheme administrator. And these should keep you safe from going into the wrong investments, but you must listen to them. And there are unfortunately some scheme administrators who operate in areas that are.
Paul, your sound's gone again.
Hello?
Yeah, you're back now.
Sorry about that. Yeah. So you've effectively got. Did you miss anything? How long was it gone for? Hello?
Yeah, just a second. Don't worry, just a second.
All right. Okay. Yeah. So effectively, you have the number of members that you want. In my scheme, that I've been in a couple, we had 3 of us that ran our business. So the 3 of us had brought our pensions in from other pensions, and we ended up using that to buy our commercial property in the Midlands that we worked from, and then we sold that in the SSAS. In 1997, we bought that, and we sold it in 2000 to buy a larger property from the DSS. Most of it was actually derelict at the time, but we bought that in our SSAS as well with a mortgage, and that's been paid off. I'll go through that in a bit. So membership, you can have up to 11 members, but it's highly recommended you have a corporate trustee and a scheme administrator rather than doing it yourself. You have to have HMRC approval and a scheme reference number from HMRC. So what happens is you go to the scheme administrator, you fill out a particular form, it can be online or paper form, and it's then asked for approval from the HMRC, and they will give you a registration number, a bit like a company. So in a way, you've got to think of SSAS like a company, because rather than a memorandum and articles of association, you get the trust deed. And you need to read that trust deed because it sets what you can and can't do in that trust, in the issue of divorce, assets you can invest into, etc. So whenever you do a loan back or a property purchase, your solicitor will need to see that and make sure that it's up to date and up to scratch, and the bank will want to see that as well. So you get HMRC approval. Once you've got HMRC approval, you're good to go, and then you can set up your scheme bank account. And also, by the way, worth knowing this, you can have you can have a multitude of SSAS related to one limited company. You're not just limited to one, so you can have lots of different SSAS for lots of different reasons. So you have a scheme bank account like a company would have, and the qualifying criteria really for this is that you really should have a sponsoring company. You can't do one if you're a sole trader or on an individual basis. So they're normally there for LLPs or limited companies. I've not done one for an LLP, but you can do them. But they're generally for limited companies that are trading. So once set up, you are a trustee, member trustee generally. So you're the member and you're the trustee. You're in control of the assets, and it's you've got your hands then on the steering wheel. And it's worth noting that as a trustee, you're covered by the Trustee Act, which effectively means that you've got to act in the best interest of all the beneficiaries. And what that means is the other trustee members and also their families. So if you try and do something that deprives another member of their assets by doing something stupid and without the others agreeing to it, then effectively you're breaking trustee rules. So a lot of the training you get out there is to teach you as a trustee what responsibilities you have and what you should watch out for. Also, it's worth noting with a SSAS, all the decisions are unanimous across all trustees. If one doesn't agree, you can't move forward with it. That's unlike a limited company. So it's worth noting that as well. Next, tax efficient business tool. Yes, for basically for the start of a business is if you're starting up a business and you're thinking, right, I'd like to, invest in commercial property or invest in some machinery or plant, or even in property, you want to buy a property or set up an SPV, a special purpose vehicle. It's good for that. It's good for growth, via organic growth or via acquisition. We used our SSAS to do 37 acquisitions, 15 loan backs, and we didn't use security for the loan back as the property, which we could have done. We used it against our client book. So the reoccurring income that was coming in from our client book on investments, we used, let's say, the clients from A to E or A to F or whatever, and we got an independent accountant to value those assets, that reoccurring fee income, which needed to cover the loan.
Paul, we've lost you again. I'm not sure whether that's can you hear me? Yeah, if you just go back about a minute. I think it might be the Bluetooth on your headset, but maybe he's...
Yeah, just keep telling me when you can't hear me, because
I'll just keep telling you. That's probably easier.
Yeah, it's easier to do it that way. So, we just very quickly, we used our SSAS to grow our business through acquisition, and we purchased 37 other businesses, and eventually the business grew and sold. We have 30,000 recurring income. Eventually, it grew to 13 million. But we did 15 loan backs to help us with that. So the bank gave us some money to purchase them, and we used our SSAS loan backs to do that. So if you're in any business, as a doctor's surgery, as a dentist, whatever you do, if you're in property, you could go and use your SSAS loan back to help you buy other businesses. That's just worth knowing that. Also, planning the exit or sale from a company or group of businesses. Often, if you're looking to sell, one of the things you're looking at is how can you offset some of the sales proceeds against tax. So up until March last year, you got 10 million entrepreneurs relief at 10% tax. If you sold your business, you were allowed 10 million. Now it's $1 million. And therefore, one of the questions that you could ask is, could you drop some of the sale proceeds into my pension, and benefit from that. And there are, you can put £40,000 in per member, but they can drop quite a bit into your pension actually, and do, you can do carry forward and all the rest of it. It's a question worth bringing up to actually put some of the money into your pension, get tax relief on it, and fill it up effectively. So planning for exit, growth or investment into many asset types. Well, you'll see that as we move forward. Types of assets permitted. Basically, what's permitted by HMRC to invest into. I'll go through. I'll read out some examples in a second. And it's for tax-free compound growth. So the assets that you have in your SSAS that's owned, it's a pension at the end of the day. And what that means is that the growth of those assets will be free of tax. And that also means rental yield as well.
Paul, you've gone again. You've gone again, Paul.
Hello?
Yeah, you're back.
All right. Right then, so some examples of where you can use a SSAS. You can use it to buy commercial property, including, for example, dental practices and doctor surgeries, retail units, industrial property, offices, shops, forestry and woodland, land for development. It's an excellent tool for property developers in utilising special purpose vehicles, in buying sites for development, splitting property developments into leased parts held for rent and selling parts, and also for property development or investment. You can invest it in public houses, nursing homes, care homes, hotels, co-living, serviced accommodation in certain circumstances, marine berths, intangible assets such as intellectual property, rights, copyrights, trademarks, whiskey in approved form, which is interesting, gold bullion in approved form.
Paul, again, you've gone.
Hear me all right now?
Yeah, we've got to gold bullion.
All right, gold bullion. Okay. So gold bullion, whiskey, an interest in property unsecured, loan back, up to 100% of the value of a SSAS can be loaned to unconnected parties, peer-to-peer lending through crowdfunding, bridging finance can be used partly as your bank. You'll see that in a few minutes. You can transfer certain assets to and from your family with a SSAS. Remember, you can have a family SSAS, and the list goes on. It just goes on and on and on. I think the thing to be aware of is that it covers a multitude of things, and just knowing that it's there and it's a great tool to help you in the advancements of your business growth, or your property empire, whatever, is well worth it. Now, contributions and in this tax-exempt vehicle and alternative products were mentioned there. But some of the benefits of what a SSAS can do internally can help your sponsoring employer with a loan back, for example, with the tax benefits of that the growth of the income of the asset, or the growth of the asset, as I said, is free of inheritance tax, capital gain tax, income tax, and the yield is free of tax. What can be taken out and when? Well, effectively, when you are age 55, you can normally draw 25% tax-free cash in one big lump, or you can do it in drips and drabs in stages. If you don't take your tax-free cash before the age of 75, it becomes taxable at your marginal rate. So you should really take your tax-free cash by the time you're 75. If you want to take an income, if you take £1 worth of income, then unfortunately you're limited in contributions to £4,000 a year. So under the rules that changed last March. So if you're a high earner, or you're a somebody that's already taken your money out as income from your SSAS pension or similar kind of pension post age.
Gone again. You've gone again, Paul.
Yeah, you hear me now?
Yeah.
So yes, you are limited to 4,000 a year, but there is an alternative product which is kind of SSAS related that's been going as long as these SSASs, where it's actuarially based and calculated, but you can put in as a male about 120,000 a year and a female 80,000 a year. So if you're struggling with this kind of arrangement to put enough money in at 40,000 per member, then you can look at that. And it's one way to look it up on Google is the alternative annual allowance, where if you're limited to the 4,000 contribution in this, you can effectively get the balance up in that. And it's based on a final salary basis, final salary SSAS. So it's a defined benefit SSAS, which hardly anyone knows about. And I've been in the industry for years, and I only came across them about a year ago. Very seldom used, but effectively you can fill your SSAS up much more quickly. The death benefits aren't quite so good, but when you filled it up, you can transfer it to a normal SSAS or another pension product. So it's worth knowing about that. I know they don't teach it on a lot of these SSAS courses. So effectively, when you put your money in, you get tax relief on the premiums. If it's the company that normally pays into a SSAS, the company get corporation tax of 19% currently. The growth within the scheme is free of tax. And when you take your money out, 25% can be taken tax-free and the rest is income. But you can use the money in there before that. Got to watch the time as well. So what I'm going to do now is cover very quickly. I'm going to actually explain it. The difference between buying property personally in a company ownership, in a limited company, or buying in a SSAS. So effectively, very quickly, if you buy a property valued at, let's say, £500,000 in in your personal name, the thing is you're going to have to buy that property from net income after tax and national insurance. So if you're a 40% taxpayer or 45% taxpayer, that's a lot. So if you're a 40% taxpayer, adding 2% NI onto that, you're looking at somewhere in the region of £862,000 to buy a property worth £500,000. The next thing is, whilst the property is owned by you and it's in your own name, it's not protected from creditors. So if somebody comes along and tries to take it off you, then it's attackable effectively. And when you then look to sell the property, then of course you're paying capital gains tax on the gain, currently at 18 and 28%, depending on if you're a basic or high rate taxpayer. If it's an investment property, and if it's not investment property, it's trading, you're looking at 10 or 20%. The other thing worth noting as well is the rental income is taxable at your marginal rate of income tax. So if you're a 40% or 45% taxpayer, you're receiving, a lot less net income from that, and that's worth knowing. So effectively, you are taxed on buying, and you are taxed on the selling. Next one is if you own in a limited company, then if you're getting the money, if you're getting the company to buy the property of £500,000 again, let's use that example, then effectively you're doing from net profits after tax. So effectively it's costing you an extra 19% corporation tax to own that property. So that 862 roughly comes down to about 617,000. That's grossing the £500,000 up by 19%. We would expect the taxes to go up post-COVID, of course, but we don't know what they're going to be yet. The other thing is with your limited company, whilst the property is owned by a company, it's worth noting that if it's in the trading company itself, then the property is not protected from creditors. So one good thing to do there is put it in a holding company or a separate company to protect it. And then when you look to sell the property, then the gain is accessible to corporation tax as a trading receipt. And then you've got to get the money out of the company, so you're probably taxed again, unless you sell the shares and you sell lock, stock and barrel over to somebody else. But effectively, if you sell that property and you double the value to £1 million while you own it, then you will pay a 19% corporation tax on the gain, about £95,000 tax. So there's a lot of tax up front on the personal ownership and a bit less on the corporate one. When you buy a property in a SSAS, you get tax relief on the contributions you've made. So if you've been paying into a personal pension before you moved it to a SSAS, you've probably had 20, 40 or 45% tax relief on the contributions. If the company's paying in for you, the company's getting 19% corporation tax relief on contributions. And therefore, if you're buying a property for £500,000 again, if you get 40% tax relief on the money you've had tax relief on before you put it into the SSAS, effectively it's cost you £300,000 to buy that £500,000 property. If the company's been getting corporation tax relief, the real net cost is about £405,000. The next added benefit, whilst the property is owned by the SSAS, it's protected from creditors, and then on the sale, it's free of tax. So the property will grow internally free of tax, and you sell the property asset within the pension free of tax. Also, the rental income is free of tax. So if you've got a mortgage, you'll pay the mortgage off much more quickly. So when I went to see many businesses over the years, when they had a SSAS that owned property, they'll be paying the mortgage off at a much more rapid rate, because remember that the rental income is received on the gross basis with no tax attached to it. So they've got more money to pay their mortgage off with. And then the cost of buying and selling, if protected from creditors, obviously the SSAS wins every single time. But bear in mind that a SSAS doesn't have to own a property outright. It can part own with your company or with yourself. So it can be a part owner of a property, and you can bring lots of SSASs together. So if there's 5 people in the room here who want to pull together and own a property as a group, they can do that too. I'm going to go through a little example that I dealt with. I call it the Neville SSAS. It's not the name of the SSAS, but it's a few years ago I came across a organisation in the Midlands who built things for industry, and they did say that the land that they were sitting on was probably going to come up for housing at some point in the future. And they owned 4 acres of land next to their building, which they owned in their company. And they also wanted to buy a building the other side of the entry gates, which they did. So we got the monies that they had in existing pensions. There was a father, mother, and 2 sons in their early 30s. We pulled out all their monies together from different insurance providers into a SSAS. It came to about 350,000. So we bought the property they wanted to buy for about 200,000, and we put the 4 acres of land in at £10,000 an acre. A few years later, that property came up for housing, and they got £500,000 an acre tax-free into their pension schemes. The parents went off and retired. The sons bought the stock from the company and set up in their own businesses, and but the parents went off and retired with an immense amount of money. Now that the sons, who had originally 30,000 in their pensions, now had over 700,000. Both of them went off, set their own businesses up. They initially rented and then bought property with a SSAS. And one of them actually was making something for universities and schools that was protecting the computers at the time. But the problem was that they were manufacturing this stuff, but the sellers of the equipment effectively fell out with the 2 people that ran that business. And I remember him saying to me, how are we going to get through this? Because if they don't exist, they're our main business that we do business with. How are we going to survive? So we looked at what we could do here, and you couldn't do a loan back at the time under particular rules to their main trading company because of a rule about taxable and movable property. So we advised them with a little bit of thought to set up a holding company and secure the loan back against the share value.
We lost you again, Paul. We've lost you.
Hello.
There you are.
Yeah. So we secured the loan back against the value of the company, but we put a holding company above it. and dropped the trading company below that. So we did the loan back to the holding company, which dropped the loan back monies into the trading company. They used that money to buy that other business. And 2 or 3 years later, they said it was the best thing they ever did. So that was nothing to do with property. That was nothing to do with acquisition. Well, I suppose it was partly an acquisition, but it was nothing to do with the usual things that people would think of using SSAS for. It was effectively to bring one of the guys on who was running that company. He was the key person to help run this one, and his business catapulted after that and did incredibly well. An example of use in acquiring other companies, well, we did it. We did 37 acquisitions, some of them £200,000 or £300,000, some of them £1.5–2 million. We were asset rich but cash poor, and our SSAS helped us do that, stopped us having to go to the bank for all of it. We didn't want bridging finance. We didn't want a third-party venture capitalist in there telling us what we could and couldn't do. So SSAS was our kind of fallback on that. The other thing, of course, is that you know, in the experience of SSAS's, it did help our business growth because of that, and offered and we were offering other forms of security, not just property. So if you understand what a SSAS can do as a tool for you, and also some of the basics of what you can secure against. I mean, I know of an IFA company that's done 20 SSASs, and they thought that you had to secure the loan back against property. So when I told them, no, you could secure it against your client book, they were shocked. And of course, it opens up in their mind lots of opportunities. It can be used to buy equipment, to pay legal fees in divorce settlements. It's actually, it's not a good thing to do, but you could actually use it in divorce settlements as well, I suppose, because, you know, the thing with a SSAS is it's a community. So if there's in our case, there's 3 members and 3 trustees. We knew what we owned because we valued it every year. But in the case of a divorce, it's pretty hard for a court to work out what you actually own because of the assets. So did you get the growth on that asset or the loss, et cetera, et cetera. And that's it, really. There's so much more we could have talked about, but over to you and questions.
Yeah, I think, Paul, thank you very much. And it is such a massive topic. And I'll talk after the questions about how some of the things have really kind of opened my eyes recently, because I turned my back on this for years, just thinking military pension, not relevant. Can I, 2 seconds, let me stop you sharing.
I'll stop it if you want.
There we are. Yeah, so it was, and I'll talk about that potentially after these questions, about how it was very relevant to me in this recent scenario where, as I say, I couldn't do it, but yet you've now looked at my scenario, looked at my pension, the contribution towards the lifetime allowance, etc. But some questions from the people in there. Paul, go over how your house can be in a SSAS.
So that one again, sorry?
It's how can your house be in a SSAS? Kaz, if there's any specifics to that, Kaz, do you want to ask them personally?
Yes, okay, thanks. It's just that my understanding was that your own resi couldn't, you know, it's residential to start with, so it's outside the parameters for inclusion in a SSAS. But you did say in your intro, you did mention your house and then went on to your properties, blah, blah, blah. So I'm just wondering if I've missed something, if there is some way you can have your residential property in your SSAS.
Yeah, thanks for the question. It's a brilliant question, and I'm sorry if I didn't mention it and explain it fully. You cannot own residential property in a SSAS, full stop, period. And if you do, you will get penalised for it as an unauthorised charge. And the HMRC will effectively tax you at 55%. So you don't want to do that. But there are some exemptions and some special cases. So a couple of quick examples would be if you are, if you've got a property that is used as a home and converts to commercial property. So let's say, for example, you've got a home that you own, and you convert it to a care home, or you can convert it to an allowable investment within the SAS, like a care home, a doctor's surgery, or whatever, then that can then be owned in the SAS. And then even if it's you want to sell it then as a private residence, if you were to do that, it immediately reverts into residential, and you'll get hit for that. So the thing you can do is sell it as you have to sell it really as the commercial entity, and that's just the way it is. You have to sell it as the commercial entity, and the HMRC will allow that. So that's fine. And so care homes are a good one. Another thing you can have is on a development site, if there's a caretaker, the house that he lives in can be owned in a SAS. Also, certain cases where there's a shop underneath and apartment above, that can be owned in a SAS, provided that the tenant takes a lease on the flat above as well. But generally, my advice would be to separate the deeds and split them out, and that's a completely separate topic. But that gives you some examples, I think, of where residential can pop into a SAS. But no, you can't put your house in. And if you were going to adapt a property, for example, to supported living or care home or something, there's a number of adaptations that you have to make it commercial. And once you've got that sign off, I think that you'll be okay with that. But I'm looking at this a bit further because other examples are coming to me on this. Hope that answers your question.
Can I just add another part of that question from what you've just said now? If you were to convert your resi into some type of commercial property, would you then lose your private residence relief for the amount of years that you've lived in it?
Well, are you saying you're selling it to? Are you keeping it, or are you selling it to? Are you changing the use of it, or what?
Well, I want to keep my property, and I've been looking recently into changing the use on the property.
Right.
And keeping it, so changing the mortgage structure to start with, and then using it for something else, but keeping it, because that's a way of actually keeping the property. And once I remortgage into this other mortgage, I'll be releasing a lot of the equity in it. And I don't like selling. I do sell things, but in the example of this property that I'm talking about, I would much rather keep it long term. So if there's any way I can keep it in the SAS, I would do it. But I also don't want to suddenly find that I've traversed some tax rule and I get taxed on the capital gain.
The moment you move it from your own name to another use and another entity, then you get private residence relief on your main residence, which effectively you would get while you own it. And then while you're not owning it, you're still owning it, but you're owning it in another entity as a commercial property. Then it's got another use, and it will have another another. You've got to look at it with mortgages. What sort of mortgage that the lender will allow. What's the use of the property, etc., etc. It's a thing that I would say, if you're using someone like me to do this, I'd involve a good accountant who understands the tax in this field as well, so we'd work together on it. But I'd be very careful about doing that. Think about your plan, obviously, what you're thinking of doing, what the long-term plan is. Do you plan to retain the property through life or whatever, and what's the benefits tax-wise and mortgage-wise of transferring the ownership to another entity? It might be better to put it in a limited company or a SAS, but the moment it goes into a SAS, you've sold it. So that would trigger any tax charge if it's been in your own name. Generally, that won't be a tax charge. But if you've owned it later on as a care home and then sold it, then there might be a tax charge. So you've got to be careful with that.
Okay, thanks.
I think that's kind of a very specific one as well, Kaz, and I'll drop Paul's contact details in at the end, because those are the sort of things that he is specialist at, shall we say, if that's all right.
Thank you.
Does the alternative annual allowance still count towards your lifetime allowance?
Yes. So the alternative, basically, it's supposed to go up with inflation each year, and the government have messed about with this over many, many years. I won't bore you with the past, But effectively, in the old days, when you had a pension, everyone thought you had to buy an annuity. But in 2016, they came out with the new Pensions Act with David, with George Osborne, and effectively, all your pension assets, if they more than 1,073,100. Then any income or tax or cash you take out of it would be taxable. So the idea is to benefit by filling up that amount, and then filling up, if you've got a wife or husband in there, filling their amount up and filling the children's up, if that's what you want to do. But yeah, you are limited to the lifetime allowance. The advantage with the alternative allowance is that allows you to build up DB benefits, DB SAS benefits. So you're not just restricted to this £4,000 a year. And I don't know anyone in this community, in the property community, that knows anything about this, but I promise you it's a HMRC approved vehicle.
Okay. Paul, there's a few which will wrap up for kind of those people who are just starting or thinking about this. Is effectively the questions being, how much do you, like myself, where I'm not transferring a pension in, okay, so I'm not coming from a corporate side because obviously I can't touch my military pension, so I can't port that in. So it's a case of, do I set up one from scratch? And if so, how much realistically, what's the minimum amount I would need to do that?
There's actually no minimum, but people who leave the MOD, police force or whatever, you've got to find out what your lifetime allowance is that you've achieved so far. So if your percentage is 50%, then you've already got 50% of the lifetime allowance that I mentioned a minute ago. So that gives you 50% allowance to build up more. And you've also got to be careful that if you've not drawn your benefits from your police or MOD pension or whatever, then that can change, because it's based on your crystallization events, which is when you draw benefits or die or whatever. So the lifetime allowance percentage can change a little bit, but if it's quite a low percentage, it gives you, I think, the freedom to set up a SAS. What's the minimum you should pay in? Well, there's no minimum really, but because the SAS providers generally charge between £600 and a couple of thousand a year, there's probably not much point in having a SAS, unless you've got a plan for it, or unless you've got 70 or 80,000 or 100,000 that you have got a plan to use it for.
Okay,
that's it.
Yeah. No, that's a good answer. And can it be handed? Can it be passed down? Can the legacy be passed down to a non-relative?
Yes, under the pension rules changes. It's very important. This is actually 2016. You should complete a nomination of beneficiary form or expression of wishes form. So if you're not in a SAS, there'll be a separate trustee, and you need to nominate to them who you want to benefit from that SAS. If it's in the SAS, then you're the trustee, so you would decide that with whoever else is the trustee. It's always better to have that in writing. Very quickly, this is vital, this is that if you don't nominate a beneficiary, the lump sum in the event of death, because the whole of your pot before age 75 can be paid out to whoever you've nominated. And if you don't nominate somebody, then it will be to the discretion of the trustees. So, so people that might get it that you least expect, an ex-wife, ex-husband, somebody you've fallen out with, who you previously said you'd like to benefit. But one thing you should also bear in mind, that unless you tell the trustee who you want to benefit, they're not going to be able to pay it to them. But there's the critical thing I wanted to mention here was that there's also the pot of money whereby you can say, I want my husband or wife or whoever or friend to actually receive that pot. And a very quick example, because it's a vital important thing. I had a case about 2 or 3 years ago, where this lady that sat on meetings worked for a bank, and she had about £550,000 in her Royal Bank of Scotland pension scheme, but she got diagnosed with cancer, and we were told that, she said, I probably might not live 2 years. Now HMRC have a problem if you move your pension within 2 years. So I checked with HMRC how they would look at it. What we did was she filled out a nomination of beneficiary form. When she died, which was just short of 2 years, all that happened was, by nominating the husband, there was no children, as the flexible beneficiary, he inherited the whole pot tax-free. So whenever he draws now income or capital from that, the pot is completely tax-free. So he could only do that by nominating him as the flexible beneficiary of a beneficiary trust. It's a slightly different thing. Maybe most of you may not have heard of that, but it's really worth noting that whatever type of pension you've got, the trustees know what you want to do with it.
Yeah, I think that's an interesting one. Brilliant. Paul, we'll do a quick couple more, and then I'll let you step out. So thank you for doing this anyway. Is Chris Castor, you wanted to ask a question about client books? Do you want to just come on and ask it?
Yeah, client books. Well, first of all, the bit about buying companies. So if you're buying companies and putting them into your SSAS, are you talking about loaning backs and then buying it with a loan back, so it's out of your SSAS, or are you talking about actually purchasing it and holding it within your SSAS pension? And if you were, what would happen if you were wanting to sell one of those companies? Would you be giving away some of your SSAS? I don't know how it would work.
Good question. I mean,
Oh, your sound's gone.
Sounds good, Paul.
Nothing.
Hello?
Yeah, you're back in.
Yeah. A SAS can own shares in a company, but it's a bit restrictive, and the value of the shares in a company can go up and down. So I would be careful of that. So what I would do is look to loan back, to do it via loan back, and get your company to do it. And the loan back rules are, quickly, you've got 5 years to pay them back. The charge of the interest is 1% above bank base rate, which is 0.1%. So it's 1.1% is the minimum, but you can charge more. It's 5 years, and you can pay annually in arrears. Yeah, we used it a lot, so that's how I would use it. Does that answer the question?
Yeah, no, that's great. Thank you. That's enough. Thanks.
Perfect. I'm going to do one more of. In fact, I'll do two more. What happens if the SAS grows more than the value of the lifetime allowance? And just say what the lifetime allowance is, well, Paul, because a lot probably won't know it. Is that then taxed at 50% plus?
Effectively, the lifetime allowance changes each year.
Sound's gone again.
Hello.
Okay.
Yeah, the lifetime allowance is 1,073,100. It does change every year, and so will change in April. If you go over the lifetime allowance, it's better to take your tax-free cash out before you go over your lifetime allowance. Gives you more headroom, and then you will end up paying more tax. It's different if you take it as tax-free lump sum against if you take it as an income.
Can you not reallocate it to other people within the SAS though? I've heard that before.
Very good question. Yes, you can. So if you've got somebody in there who's been in there years, and the scheme administrator or professional trustee doesn't put down a marker of who's got what, you could say, well, as the one who owns more, you'll take all the losses if there's any, and all the gains will be made by the other person who's got less of it. So it's husband and wife. That's a great example of where you could do that, and that's been used a lot. Yeah.
So when you say the tax-free amount, so let's say you got to your lifetime allowance of 1,070,000, whatever it was.
Yeah.
What would be, and you were, let's say you were 50 years old, what would be the tax-free amount that you could take out at that point?
You can still get tax-free cash, but I mean, a lot of professions like dentists, doctors, and high earners hit this problem, and they shouldn't really. But effectively, it's 55%, and effectively, and another 20-25% on top. I've never had anyone have that situation because we don't let them get there. It's right. Silly to get there, unless you've got piles of money coming in from your profession and you still want to keep filling it up. That's up to you.
Okay, I'm going to do one more, and it's about defined benefit scheme that can be transferred. How is the decision to switch made, and at what point does it become viable to switch out of a DB?
Can you hear me? Yeah. So this is you've got to be very careful with DB schemes. I'll go through these very quickly. First of all, you need professional advice, and you need it from a person who's got what's called the G60 certificate or exam passed. And there's only 5,000 people with that in the UK, and there's 25,000 IFAs. 2,500 of those are administrators, so there's not many IFAs. Take into account the British Steel issue from a couple of years ago, and we have...
Sam's gone.
Yeah, the FCA and basically gone to town on this. So you're going to find it really hard to find an IFA that will do this. Strange enough, you know, there's not many out there who are. And the thing is that the first thing they do is they ask the question of they come from the point of it is not a good idea to move it. So if you want to really move it, then you're going to have to find somebody. It's going to be hard to find somebody that will help you move it. That's a real challenge. It's getting harder and harder and harder. But the IFAs have got to pay a massive increased indemnity insurance premium these days, and the FOS complaint limits of what people can get on complaints has gone through the roof as well. And in fact, the firm I was with 2 years ago had to shut down. They couldn't afford to trade anymore. A lot of IFA businesses can't. So the small IFA firms are really struggling with this. But the key thing is be very careful before you do. Some are worthwhile, some are not funded very...
Sam's gone. Lost you. Not back yet.
Can you hear me? Yeah. Just be very, very careful when you're looking at moving a DB scheme. It's probably not a good idea to move it. So if you are leaving the MOD, you can't move it anyway. Leaving, you know, and unfunded schemes from, you know, the NHS and stuff like that. But get professional advice and see if you can build up funds elsewhere, because those schemes that you're moving from, one of the reasons you can't, or you're struggling to move them, is because they're so good.
Yeah. Paul, I'm going to cut the questions there. Thank you so much for doing tonight as a little intro. What I'll do is I'll collate if there's any more questions and come back to you. And obviously you and I are speaking next week. But thank you so much for tonight. I think it was very, very useful for that. And I'm going to obviously continue now with the guys and talk about a few other bits and bobs. Thank you, Paul.
Yeah, I'm just going to thank everybody for listening. And final thing I'll say is they've got so many uses. Investigate.
Just as the sound goes one last time. Take it easy, Paul. Thank you now. Right, Paul stepped off. I tell you what, it's a large topic, guys. I wanted to bring him on, even though I know it was probably a Bluetooth issue, but he was not a computer savvy person. We covered that at the start of the call before you guys on. And the reason I wanted to bring Paul on, to be honest, it's very, very high level stuff, but that he was talking there, I actually thought he was going to dumb it down quite a lot. But for those people who've never come across a SSAS, a small self-administered scheme, it's something that I would encourage you, whether you are in property, not in property, in the military, in the police force. I know there's a lot of doctors in here. There's a lot of pilots. There's a lot of people who work in other industries. Look into it specifically. And I would, to be perfectly honest, I would recommend Paul. And I will connect with him on social media, Paul McElroy, and I'll drop his email address into the group. He's more than happy to field any questions. Because he very much looked at my situation, for instance, where many others have said, you know what, it's pointless, Richard, for you doing that because of your military pension and your company structure that you've got going on now. It's not worth doing it. And he looked at my situation and he mapped it out. And last financial year alone, he would have saved me £92,000 had it been done correctly. Not just in tax, in very, other things. That's involving crypto assets, that's involving, most of mine was from loan back. So I do a lot of short-term lending, as a lot of you do know, which at the minute goes through my limited company, of which every single penny I pay corporation tax on the profits of that. So a lot of things there, crypto assets being a big one at the moment, that if people do have large gains in this community, then I do advise you to seek advice. He is not an expert on crypto, but there are many out there. I know I know a number of people in this group have, but I know Andy, you're on, Andy Quinn, you have done crypto. Paul has heard of it. It's not necessarily his specialty, but some of the things that he can do. And as I say, that's with a military pension, a pension that I cannot touch. It's my military pension is 33% of my lifetime allowance, and actually then it leaves the remainder to do it. So it's a big topic. Don't think it's not for you, as I always did. Have your specific case looked at, what you've got, what you physically own, what you and where you want to be. That was the biggest one for me, is when actually I die, where does that money go? And actually, does it transcend a number of generations, or does it die at the next generation, which is a big thing at the moment with a lot of other schemes. It would actually die at that next generation rather than being able to transcend multiple generations. So he's not the best at PowerPoint presentations, but trust me, he's the best I've ever come across talking about this subject. Right, hope that was useful. Let's have a little chit chat about what else is going on in the world. What an absolute shit show we've had this week in the market, shall we say, with short squeezes that nobody'd ever heard of before this week. And that's the first thing I want to cover. Obviously, like I said to all of you, AMC and GameStop were the ones that hit the press. And what have they done? It was inevitable that they were always going to shit their pants, because the foundations of those companies are literally made of papier-mâché, okay? They are companies that really are on the bones of their arse right now. And all that happened was an attack on Wall Street. Now, it's not for me to say, was that right or was that wrong, what they've done. What it's done is highlight to the world how market manipulation can happen. The kind of power of the people, social media has created market manipulation so powerful, you know, it's led to billions and billions of dollars of loss for certain companies. Now, I'm not going to go into what short squeezing is, but it's nothing new. A short squeeze has to be done on a small company. So when we've seen again in the press short squeezing happening on silver, that's not in the same sense as the short squeeze on GameStop and AMC. However, the fundamentals for silver rising still remain the same. And there is a true classic shortage of supply and demand, but they are two completely separate things. It's not a short squeeze per se. Now, the other thing I want to talk about is that never ever FOMO into anything like that. And I think I did a post saying exactly those words. The second thing is, now everybody's looking at the top 10 list of the highest shorted stocks out there. And you can pick out quite a few of them that I've spoken about. Space, okay, Virgin Galactic's on there, and a number of other ones on there. Now, you'd never seen that list 2 weeks ago. Nobody'd ever seen that list because you weren't looking for it, okay? This list is nothing new at all. And it's one of those things that's been out there in the ether evermore. And I guess what I'm saying is, firstly, don't read what's on that list and then become scared and exit a company. You need to, and also don't invest in a company that you see on that list trying to replicate what's just happened with GameStop, trying to make that quick buck. Yeah. That is what's just gone on is gambling, not investing. It's as simple as that. It's gambling, not investing. So all I'm trying to say is kind of always when you read, you know, by all means follow Wall Street Bets, follow them on Reddit, follow them on Telegram, listen to what they say, but 99% of it is rubbish. And what I find that it generally does is then distract people, max them out, and actually then cause them to make bad investment decisions because they're following what potentially a thread on there has said. If you go back in Wall Street Bets and you look at threads that they've said for the past 6 weeks, 90% of them will have gone to absolute rubbish, okay? Yes, boom, GameStop. If you were in it, you've made a lot of money. 90% will have failed. So, you know, by all means follow them, but don't get yourself distracted by actually what investing is. Investing is about understanding the true fundamentals of the companies or the asset classes that you are putting that money into. And that is critical because there will be 1,001 people who are broke now on the back of trying to play those short squeezes by not understanding what they're doing. They're gambling. What it's done is it's cleared out the Robinhood investors. Yeah, there will be a generation now of investors who think buying any crap stock will only go up. But actually, if I'm honest, I think the market's probably had a scare because of what's happened today. So actually that generational change probably hasn't happened. But I kind of wanted to emphasize that as a whole. Now, what's going on in the wider market? Obviously, on the back of that, there were a lot of hedge funds that didn't want to liquidate their short positions. Now, what they then subsequently did is they were forced to liquidate other positions, other healthy companies, in order to create revenue and margin. So these short positions on GameStop, AMC, and a number of others weren't automatically liquidated. They fed the beast. That's what it was about doing. It's creating that margin. Now, what that led to last week was the downturn in most of the world markets. We saw the Dow Jones have its worst day and its worst week since March. Yet again, let's look at why it did that. It did that on the back of market manipulation. That's what you've got to view this up as. It is simple as that, market manipulation. And to be honest, the market's still being manipulated today with regards, and I'll revert back to GameStop again, it's being manipulated still. There were, I think, I'll read the stats out, 42% more buys for GameStop still today than there were sells, yet the market was still plummeting. That at the very least should have plateaued the market, okay? That is still classic market manipulation. There's all sorts currently going on with the silver. Well, I guess what I'm getting at is we're looking at why that Dow tumbled this week. And it wasn't due to the economic situation. That was not the catalyst for, should we say, the correction that I feel still is inevitable. It was a downturn based on simple market manipulation. And lo and behold, what's happened today? The Dow's boomed, I think, 600 points today alone. And again, we're still in this horrendously choppy, zigzaggy, uncharted territory until in the equity markets, an all-time high is either broken and broken with confidence, we will remain hovering along this top, or we see a downturn based on the fundamentals of what's going on in the world and not just market manipulation. So that's kind of where we are with the world equity markets at the moment. Now, what have we got going on with, so where do I see that market? I still see us grinding up. I still see those markets grinding higher, okay? Not necessarily categorically, but I see the Dow, the S&P, so the American markets grinding higher for the time being. The downturn will come. Okay, it's like death, taxes, and nurses. It's guaranteed. Okay, the downturn will occur at some point, but I do see us grinding higher in the short term. Currency markets, equity markets at the moment, as I say, it's a time to just step out. Now, this week I played a few very short and volatile swings. And what I don't want to do is start spamming our group with those positions. But a few people have said, please put them in there. Now, I will start doing them and I will put them in there. I will caveat every single one that they are time sensitive. Yeah. Everything, if I start doing this, they are time sensitive. I will not be answering questions for the next 5 hours about it. If I put that in at 2 o'clock and say, this is a swing trade to be taken now, if you don't see that at 2 o'clock, you do not do anything with that. Yeah. Now, I'm doing this almost against my better judgment because this is not a follow me service and I despise follow me kind of services, but I will allow you to see kind of the swings, which I personally am playing nothing of advice. Any swing trade is a small position of it, likes of Fubo, SNDL, a few of the others that I've put in there, notwithstanding what was put out there in January, that was a different play. So for those of you who may want to look at those, by all means do so, but do your own research. If I put it up there, spend the next 10 minutes intensively looking at why I have done that. Okay, do not just blindly follow in. So they're short-term swing trades at the moment. And if I'm brutally honest, that at the moment is where I'm currently sat on my hands. With regards to writing the next report, it's something that's on my mind. But again, investing is about patience, and none of us want to be patient for an extended period of time. We think our patience a week here, a day here, but unfortunately right now with what is going on, maybe a little bit of patience will pay us all pay us all in the long run. And like I mentioned, I was potentially looking at liquidating an element of some of my positions, which I haven't done, but if I ultimately do, you will be the first to know. So I think that sums up the equity markets. The last thing I wanted to talk to you tonight about was we're going to revert back to the crypto sphere, and I'm going to talk to you about staking and what is staking. So again, I stake a number of my coins. I'm going to just share with you here a website. Now, to stake a coin is, I'll talk about what's on the screen in a moment. So let me talk about a bit of background. To stake a coin is where you are giving it to an institution where they will, and we'll not get into what they do with it, how the interest is earned, etc., etc. But ultimately, you are placing it on an exchange. This is Binance, and we'll look at another one in a moment. You are placing it on an exchange, sometimes for a defined period of time, where you can gain interest on that coin as well as the gains it would make as it fluctuates. The 5 to 10% gain Ether made today, you would still make that gain as well as the potential interest rate stated. Now, I'm going to start on this site here, BlockFi. Now, I stake anything on one of these platforms, no matter how they are secure, but they're never as secure as a hard wallet, your Ledger, your Tether, although they're never as secure. So you have to be comfortable of that security. Don't get me wrong, this one, for instance, BlockFi, part of this is owned by Gemini. Gemini is the largest fund in the world with regards to this. Gemini is owned by the Winklevoss twins, and that's the level of due diligence you need to go down before you ever stake a coin. Okay, so BlockFi. BlockFi only allows you to stake a certain number of coins, okay? Ether, Bitcoin, Litecoin, and stable coins like USDT, which is Tether. So I stake 50%, me personally, what I do, I personally stake 50% of my Bitcoin and Ethereum holdings on BlockFi, okay? And I receive around 8% annual interest on that, and it's paid out monthly. Okay, and it's paid out in either the currency that you have deposited, or it's paid out, you can change it. So for instance, I earn around $1,400 per month in interest, and I have all of that in BlockFi, and I have that paid out in Ethereum. So every month I will have 1,400, or it varies because obviously your balance fluctuates. Bear in mind that your balance is daily fluctuating because the balance is on the fluctuations of the underlying asset, Bitcoin and Ethereum. But ultimately, that's still giving me around $1,400 per month paid in Ethereum to the BlockFi wallet. Okay, so that's me staking those coins. Now, with BlockFi, you can remove that at any time. So I could log on right now into my account, and I could remove my I could remove my interest. What I'm going to do is I'm going to log on. I'm not shy of what I've got in here, and it's not about bragging, but I want to show you the inside of this. Okay, and I think it's important potentially that you see this before you do this.
Are you recording your password as well this time?
I know I've got to go. It's got to go onto Google. It's got to go onto Google Secure here, so you'll not get this one, which I've got to go onto my phone for. So let me just open up this, and I just want to show you how this works, because you've got to be very. If you haven't used that Google Authenticator, it is a very good app. Right. So, like you'll see here, I have earned interest today of so $1,500 I earned in interest last month, paid out to me in Ethereum. Okay, and it's as simple as that. I could go on here and I can withdraw my funds now, okay, and do that. But as you see, they don't cover a huge amount of coins. You can trade on here. So I moved a number of Bitcoin into Ethereum, so you can move from one asset class to another on this platform. So you don't have to then go back to an exchange, then back to here, okay? But this ultimately earns you interest. Why, Ethereum did well today, didn't it? This ultimately earns you interest on your coins. But I, once again, caveat, BlockFi is secure. It's probably the most secure of the platforms out there, but it's still not as secure as your hardware wallet. So you have to carry that risk. Okay, so that's, and that is up to you. How much, but I've got a friend of mine, he's got every single coin staked. Okay, that's his level of risk. I personally don't. What are the chances of something going wrong in there? It's like any investment. Okay, just because it hasn't happened doesn't mean it won't happen. So that's BlockFi. Okay, now Binance also offer staking. Now Binance will offer fixed savings and they'll offer staking on certain coins. Now, and again, if you use Coinbase, I'm sure they do the same, or whatever, all the other platforms, I'm sure they do the same as well. Now, they will offer staking again on your standard kind of coins, but they will also offer on select periods of time, they'll offer DeFi staking. So that's for your other altcoins. Is it going to come up there? So like your Cardano or, you know, your Link or your other ones. Again, if you're into those, you can stake them all, but you can't stake them at all times. So what will happen is Binance will put up so again, they've got no DeFi at the moment. They will just put out a post saying, ADA or Cardano staking, either they have a few, Cardano staking for X period of time, and they will sell out. So recently they did a Cardano stake for 90 days, offering 15% interest. Yeah, so you could stake your ADA, your Cardano, for 90 days and earn 15 annual, not 15% in that period of time, but an annual equivalent rate of 15%. That sells out very quickly. So if you don't get the notification or you don't see it, you'll come on here and it's gone. Now, I've staked my Cardano on Binance for 30 days. Sorry, 60 days actually. So they generally will offer here, you can see they're offering 7 days and 30 days. Sometimes they'll offer longer, they may offer 90 days, they may offer 180 days. So another level of consideration, when you're staking on Binance, that is an exchange, okay? So where BlockFi, actually, if you do a bit of research, hasn't had any history of ever being hacked, exchanges have. Okay, so always bear in mind, you're still leaving your coins on exchange. They're always more secure on that wallet, and I will keep on emphasizing that. The other one is if you're staking the likes of like DAI, you've got down the bottom there, which was one of the recommendations I meant, or Cardano, and you stake them for, let's call it 180 days. And let's say Cardano or does the pump, which today it is currently pumping, it's done 20% today, and actually that gets to like the 50% mark. A wise person would probably think, you know what, I'm going to set this as a pump, this is a squeeze, I'm going to jump out of that coin right now, okay, back into fiat, and I'm going to wait for it to drop again, or I'm going to transfer it now into your Bitcoin or your Ethereum. Now, if you're tied up for 180 days, you're tied up for 180 days. You cannot touch that coin. And what's happened in the past is people have watched their coins escalate by 100, 150%, and then crash down by 200%. So taking out all of their gains and then 50% of their original holding. And they cannot touch them because they've staked it for that period of time. So that's what staking is. It's tying that coin up, okay, for a period of time to earn interest on top of your natural gain within the market. And that's it. Do I recommend it? Hey, you know what my policy is on that right now. It's go and do your own research. I personally stake, as I say, 50% of my Ether, and as you can see, it does 50% of my Ether and Bitcoin. You do pay tax on the earnings of staking. Okay, so when it comes to your your tax filing for your etc., then you will pay that. If anybody's interested in going on to BlockFi, I'll drop a link into the group. Okay, and by using that link, you'll get $10 when you sign up. I think it's $20 actually, which is, you know, if you're like me, 20, you know, it's better than the kick in the teeth. So you may as well have that $20. In the interest of your stake, do you personally or your company or other? Okay, so Kaz has just asked, with BlockFi, in the interest of my stake, is it personally or your company or other form own it? So again, I am looking at moving my crypto assets into one of two places, either an offshore company or entirety into the SSAS. And at that point, the interest becomes an addition to the SSAS. So again, it's a tax-free benefit of that. So that's what staking is. Do some research. I wouldn't spread, you know, there's many other sites out there. There's I think one called Mezzo, which offers big rates on staking. Anything out there which is offering big rates, just stay away from it. Okay. You know, BlockFi's, you know, what I've shown you tonight are the safest ones. Do your own due diligence, do your own research, put into that exchange for staking what you deem realistic. They are safe to an extent, but they're never as safe as holding that on your hardware wallet, which is then subsequently stored somewhere else. Okay, so again, view it as you see fit. I personally stake. I know some people who stake 100% of their holdings. You know, a good friend of mine, he's got just shy of 1 million, 100% staked, where I've got another friend who won't stake a penny. Okay, so do look at it, but by all means, I wouldn't go beyond BlockFi for your main Ether, Bitcoin. And if you're doing any altcoins, the question you've got to ask yourself with an altcoin is, how long do I tie this up for? If you're comfortable being in the long game, comfortable never looking at it, dig out blind. But bear in mind, if it pumps, you'll never get out. As I say, I've tied my Cardano up. I'm happy if it pumps in that period of time and then retraces, fine, so be it. I'm in that for the long game because I see the longer term benefits of that. Guys, any questions? I think I've done all the ones. Are you still holding off switching? Yeah. Alex, I'll drop that into the group, but yes, at the moment I am. Guys, hopefully that was useful. Now, I'll drop Paul's contact details. He can talk the hind legs off a donkey. He would happily talk to anybody about your personal situation. But trust me, if you are in a position that, like myself, you are just thinking, do you know what, how best can I save or be more tax efficient? At an age of 44, do I mind that I can't really touch it till 55? No. Is it generational wealth that'll hand down if I'm, you know, killed, injured, whatever? It's by far the best tool for that. But again, you need, like he said, you need kind of that 70 to 80,000 to start it off. But I look at the short-term lending, for instance, that I've done, and that's what I had a huge tax bill on last year, and he would have immediately saved that tax bill on that money. So every situation is different, and that's about it. What am I doing with my stake? I'll leave it in there, Marcus. So it gets paid in Ethereum too. So it effectively compounds in BlockFi. Yeah.
Just on space, what are you thinking about? I've just noticed, I put a post on earlier about a valuation of $30 from.
Yeah. So right. So you've got to, again, you've got to look at, you know, you're not all in on a company like that. You know, it's you know, and that's it. If you are becoming uncomfortable, you know, on Virgin Galactic, if you've had good returns on Virgin Galactic, remove some risk from the table. Immediately remove some risk from the table. You know, if you are up, I think I'm up well over 100%, remove some risk from the table. And at that point, you know, we've got a test flight window's been announced. If that test flight, like what I think 2 test flight ago went pear-shaped, the market, the stock will naturally crash. That is inevitable because it's bad news. If it
They've pegged, haven't they, for doing a civilian flight at the end of 2021?
I'll have they for the end of next.
Yeah, it's a charity thing. Yeah, the guys got him, the charity person, and 2 people that can win it on a sweepstake.
Yeah.
Interesting.
He's on the next one after this one, Branson, isn't he? I think this is the last one before Branson puts himself in the seat.
Or is it Branson next? Yeah, but they've said this one for the end of 21. So I think November they've tagged it for.
Yeah, I think this will be an interesting. This is kind of the marker in the sand because I think it's on the 13th, because I think if that one goes badly, then that's a huge setback for the company. But I think if that one goes well and Branson has openly put himself up for the next one, and he is kind of that sort of person that if he says it, he'll follow through on it.
He stuck himself up in that balloon a few times, didn't he?
Exactly. So I feel at that point it will do very well. But don't be leaving your entire position there hoping that test flight goes well. I do see the company having massive legs for the future. But if you've done over 100% and you are sat watching it on a daily basis, take some of that risk off the table. Standard investing. Yeah.
It's an interesting company. That's why that's the only reason I really care about it. Because it's a really interesting thing, you know, and it's good to be part of it.
Get a little bit of risk off that table.
Yeah. Well,
right. Guys, hope that was useful. I'll drop a link in if people are interested. Do some research on BlockFi. Do some research on staking. Okay, there's many YouTube videos out there which will talk about BlockFi, who owns it, what risks there are. There are very few risks, but as we know, with everything, there is always a risk. It's never as safe as holding it on a hardware wallet. That is the only 100% safe place for your crypto assets. Okay, but staking, don't get greedy. Okay. I'd say I'm comfortable with that risk level. I'm comfortable in the due diligence that I feel that is, I'm not going to say 100% safe, but I'm comfortable that it is safe. But own due diligence, guys, if you wish to stake. I'll drop a link in right now into the group and I'll pin it to the top for anybody who's interested in BlockFi. You may as well get your free 20 bucks. That's about it, really. Guys, great session tonight. Loved seeing you all again. And yeah, we'll speak again soon.
right. Cheers, guys. Thank you. Thanks, Rich.
Cheers, Rich.
Thanks, Rich.
Thank you.
Cheers, Rick.
Thank you.
Rick.
Cheers.